Hey, I'm Ben from Modern Graham, and today we are going to do a Modern Graham valuation of Lennar Corp. So be sure to stick around to see what I think of this company. Now, of course, the company name is Lennar Corp. The ticker is LEN. The current price is $97.70. The sector is consumer cyclical, and the industry is home building and construction. These are the things on the balance sheet that I find most important. We have the total current assets, the total current liabilities, the long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. All of these figures will come into play in this valuation. Over here in this chart, we can see the earnings per share diluted and the dividends per share over the last 30 years. And you can see earnings have gone up and then they hit a big drop in 2006, and then they rose back up a little bit, but they have done pretty well for the most part. Dividends have not been as steady, and we'll look at the details now. Earnings, looking at the earnings, you can see they have had positive earnings most years, except for a stretch in 2007, 8, and 9, which coincided with the bursting of the housing bubble and the financial crisis. And then over here, we have the earnings per share Modern Graham. This is a weighted average of the last 5 years of earnings. We take a look at the 5 years. We put the most weight on the current year and the least weight on 5 years ago. And that helps smooth out the business cycle so that you can see the real trend in earnings. And overall, since the end of the housing crisis or the financial crisis, whatever you want to call it, earnings per share Modern Graham, the weighted average, has been on the rise. This year, however, it is forecasted to go down a little bit. Not too much, but kind of flatten out a little bit here. And that is interesting to note. But that is also, again, just a normal thing. Like if you look back here in 16 and 17, there was just a very tiny rise in earnings per share. As long as we're holding up pretty steady, that is fine. We don't want to see negative, though. We never want to see negative earnings. Dividends, you can see the dividends per share here. They have paid a dividend consistently throughout the entire 30 years. There was a time when they have cut it, or they have had many years when they have not increased it at all, which is a little concerning, but they have never not paid the dividend in these 30 years. So that is a good thing. Dividend growth, again, you can see there have been many years where they did not grow it at all, but they have had some years where they grew it substantially. And over here, you can see the dividend payout ratio. That has been very low most years. There were a couple years where it was rather, not relatively high compared to other companies, but high compared to this company. Most years, they keep that dividend payout ratio very low. So they are using a lot of their earnings and putting them back in the company. Stage 1 is to determine if the company is suitable for the defensive or enterprising investor. And remember, the defensive investor is one who is not willing to go into a lot of depth in their own research into a company, so they have very stringent requirements. So let's go through. They need to pass 6 out of the 7 tests. Number 1, the market cap has to be over $2 billion. It passes that. Current ratio has to be greater than 2. It easily passes that. Positive earnings per share for 10 straight years. It passes that. Dividend payments for 10 years. It passes that. Increase in earnings per share in the past 10 years using 3-year averages at the beginning and end. It passes that as well. It went from 275 to 1261. That is more than a third. Price to earnings ratio. This is the PEMG. That is using the weighted average earnings there. So price over the weighted average of earnings gives us a PEMG of 8.58. That is less than the defensive investor's requirement of 20. And then the price to book ratio has to be under 2.5. And here we have the price, 97, and the book value is 82.77. So the price to book ratio is 1.18. And if you've been keeping count, that gives us 7 points for the defensive investor. It is suitable there. By default, that means it is also suitable for the enterprising investor because the enterprising investor's requirements are not quite as stringent as those of the defensive investor. And here we find even if it wasn't suitable by default, it would be anyway because it passes all 5 of the requirements for the defensive investor as well. Now, if you've been enjoying this video, please take a moment to like the video, subscribe to the channel, and download the free valuation calculator found in the description and the comments below. So stage 2, we want to determine the intrinsic value. And remember, the price and the intrinsic value are 2 different things. The price is what the market is currently paying, and the value is what the company is worth. And to calculate that, we use Benjamin Graham's formula from his book, The Intelligent Investor. And that is value equals earnings per share times 8.5 plus 2 times the growth rate. And we have updated this to have the earnings per share modern Graham in place of regular earnings per share. So we have 2 variables to calculate, earnings per share modern Graham and growth. Let's go ahead and calculate those. Again, earnings per share modern Graham is a weighted average of the last 5 years of earnings, and we get an estimated earnings per share of $11.38. Put that in there, and we take the amount from 5 years ago, $4.78, and then we calculate the growth between those 2 figures of 138%, divide that by 5, and we get an average growth of 27.62%. Then we throw in a safety margin as well because growth is such a key figure in this variable. You don't want to overestimate that amount. And so it's a good point to have a safety margin to lessen your estimate here. And we get to 20.71, but then we have another safety margin figure here of 15%. That is a cap on the growth rate. So this formula is derived from the formula for determining the value of something in perpetuity. And here we are then saying that the growth rate is what the company will grow at in perpetuity forever. And it is unreasonable that any company could grow higher than 15% in perpetuity. And so we cap that at 15%. And that's what we use in this calculation. So we take the earnings per share of $11.38 and the growth rate of 15%. And we get the value of $438.21. Then we can look at the handy chart here and see that the current price is $97.70 and the value of $438.21 is way more than the current price. And so this one appears to be undervalued. And over here in the Modern Graham opinion section, you can see that the current price of $97.70 is only 22% of the intrinsic value, and therefore it is undervalued. You can look at it a couple of different ways too. You can look at net current asset value. That should be a floor to your price or your value. And we'll talk about that more in a moment, but that comes to 45.24. It is above the floor. Then modern Graham value based on 3% growth. If you put 3% in there, the value comes out to 165.04. And if you put a 0% growth rate in, you get a 96.75. If you put price in for value and solve for growth, you find that the market is implying a growth rate of only 0.04%. So the market is thinking that this company will not grow any further, ever. And so if you disagree with that, if you think the company will grow more than 0, then you might view this as undervalued by that metric. Coming down here, we have the Modern Graham grade. This takes into account other factors to figure out, to give a letter grade to it, kind of like at school, A through F. And that helps you compare this company to companies in other industries. So it gets 2 points for investor suitability because it is suitable for the defensive investor. It gets 1 point for being a good price to value. It gets 1 point for trading below its Graham number, which we'll talk about in a minute. It gets 0 points for long-term dividend growth. It gets 0 points for having a dividend yield above 2%, but it gets half a point for trading at a PE-MG ratio below its industry average. And so it comes to a total score of 4.5, which is an A- grade. Stage 3 is further research. If you've gotten to this point and you've determined that it is suitable for your investor type, and you've determined that you believe it is undervalued, then now would be the time to do further research to determine if it is suitable for your individual portfolio. You have to do this. I can't give you a recommendation. I'm not an investment advisor, but also I don't know your portfolio, your diversification needs, your goals for your investing. This is something you have to do. But here are some things that could be useful for that. Again, the net current asset value should be a floor to your valuation of the company, and that's because this is what you would get if the company took all of its current assets, its cash and anything that's liquid, and paid off every single one of its liabilities. That's how much cash would be left per shareholder. So that is the bare minimum this company should be worth. If it goes below that, then shareholders could take the company and force the sale of all the stuff and make money. And so that is why this should always be a floor to any value of a company. Graham number formula. This is a formula that people have taken to derive from the defensive investor requirements to determine a way of putting a number on those. And here we get a Graham number of 127.43. And again, it's trading below that. So it's another way of looking at it as undervalued. PEMG, again, is 8.58. Current ratio is 16.55. PP ratio is 1.18. Current dividend yield is 1.5%, and it has 4 years of consecutive dividend growth. Now, stage 4 in the analysis is to look at the chart. And that's because if you've gotten to a point where you've decided this would be a good fit for your portfolio, then what you want to do is make sure that you are trying to time it right so that you can maximize your profit and get the right entry. And we do that by looking at the chart. You'd never want to determine your value from the chart, but you can try to get a good entry point. And you can do that by looking at the market's momentum. And here we can see that the company on the daily view has been on the rise. It is in a bullish trend right now. And it has had some signals lately in these candles, like a bullish engulfing or a bearish engulfing candle that would indicate that a reversal is coming. And sure enough, there was a reversal the next day. It's currently been on the rise again a little bit. And so it's kind of interesting to see where we're at right now. Come down here to relative strength index, and you can see that we are close to the overbought range, but we are below that a little bit. I would anticipate that now might not be a good time to enter based on the current chart as of recording, but you want to watch that as well. And it also shows that it has a dividend coming very soon. So that won't be paid out, but the ex-dividend date, so anybody who is a shareholder of record as of the 26th of January will be qualified for that dividend. But that is where we're at. So if you've liked this video, thanks for watching, and I will catch you next time. Take care.